bem-vindos ao IBEF. Eu sou José Filipe, sou presidente da diretoria executiva do IBEF. É um prazer tê-los aqui. Eu queria estender as boas-vindas a quem está nos conectando aqui remoto, também que é um programa que nós temos hoje. E queria agradecer, então, aos nossos patrocinadores, mantenedores. E antes de passar aqui para o nosso tema, queria falar só um pouco sobre os nossos próximos eventos. Temos aqui, então, a previsão aqui no dia 30, na Comissão Técnica, no Mercado de Capitais e Tesouraria, começando a falar caminhos para o IPO e debate. Acho que é importante sempre a gente estar com esses temas atualizados, porque o mercado pode estar difícil agora, mas é sempre uma oportunidade na frente, tem que estar preparado, né? Também no dia 12, também um evento importante, também esse de manhã, que é a resiliência cibernética e o impacto dos KPIs financeiros. Também bastante interesse da categoria de finanças, né? Então, acho que hoje a gente vai ter um programa especial. Temos o prazer de receber aqui representantes sênior, né, dos temas, mas eu vou poupar aqui, vou convidar o Charles Pucci, que é o nosso conselheiro de administração do IBEF, para fazer as boas-vindas aqui, assessoria. Thank you.
Obrigado, Filipe. Nós vamos passar agora para inglês, conforme havíamos dito que o evento será todo em inglês. Ladies and gentlemen, I apologize for the delay. So without any further postponements, I would like to introduce you to Professor Salvatore Cantale. Professor Salvatore is a finance professor at IMD in Lausanne, Switzerland. And recently he was also appointed as director of the Center of Board Programs at IMD. So for me, it's something very special because I did my MBA originally at IMD, and more recently I did my board diploma in IMD. I am a former CFO, former CEO, and board member. And so what Salvatore teaches has so much to do with my life experience and my interests. One of his articles written recently is about the triumvirate of the CFO, CEO, and board, where the most important strategic decisions that the companies take involve capital allocations, M&A, and other initiatives where the CFO is naturally involved with the CEO and the board. So this is a joint event from the Brazilian IMD Alumni Club and from IBEF, Brazilian Institute of Financial Executives from São Paulo. Without any further delay, please welcome Salvatore Cantale.
Maybe. Would you like to hold all questions for the end? No. So let me. It's a pleasure to be here. Sorry for being. It is my fault to be a little bit late. So I take this, 100%. There was a little traffic that was not in my mind, and then the cab dropped us somewhere else. So I had a really nice walk in the neighborhood to come here, and I made it. Eventually, I made it. So hopefully it's okay. I'm gonna be a little bit quicker. So at the end of the day, you're gonna be breaking even. All right. So it's okay. So today I would like to talk about profit and growth. This is a project that I've been having like for the last 6 or 7 years, and let's see what you think about this. Sometimes we feel that there is a little bit of trade-off between the two. And today I actually have like a little bit of research and some cases that would say like sometimes this is not necessarily the case, and we can actually push for both. No reason to wait until the end for questions. So if you have questions, just raise your hand and talk, or just talk. Okay, as just talk, I think life is gonna be perfectly fine with that. So my project started, and maybe some of you actually know some of this project because I'm happy to present this whenever it happens. Started in 2019 when I had the chance to actually work with Porsche North America. All right. And it was an interesting project that we had. It was a consulting project on my side. And I don't know if you ever heard this idea about the Porsche Passport program. It's not very famous. Let me tell you a little bit what it is, and then we'll understand how this relates to that. Generally speaking, if you want to drive a Porsche, you have to buy the Porsche, right? This is typical thing that I have to do. I'm from Sicily, so sometimes we steal the Porsche. So this is why I mentioned like where this is coming from. But maybe this is hopefully this is not the best the best takeaway. But sometimes we disassemble and then we do the opposite of mergers and acquisitions. We do this kind of things. But hopefully this is not the only thing you will remember about today's speech, because otherwise this is not a really good thing. The Porsche Passport program was a subscription mechanism, right? So instead of buying your Porsche, actually entering in the subscription mechanism. Let me show you what it is. So hopefully, so this is maybe it's a little bit small for you. Anyway, there was two of them when we launched in 2019. Was the launch was a little bit. There is no 911 over here, which is the very important car over here, and then we have the Accelerate over here. What is the Accelerate program? Basically works like this. You pay $595 and you are part of the Porsche family. This is a one-time fee that you pay once and forever, and you are part of the Porsche Passport family. After that, you pay $3,100. What do you get? You get the ability to drive one of these cars at any point in time. All right. At any point in time, there's to build an app, and through the app, you really book the car that you want. Today is Wednesday. If I were at IMD, I live in very close to Lausanne, so I take the train. But if I were part of the Porsche Passport program and I was in Lausanne, probably I would use this car in order to go to school, right? So I would, through the app, I would book a car with Porsche. I would tell them when I want the car. Probably I'm going to leave the house between 6 and 6:30, as I do normally. Someone is going to bring the car. Okay, someone is going to be a white glove. Someone is going to bring the car. The car is going to be with insurance, full gas, and of course, everything is going to be clean and ready to be used. The only thing I have to do is basically drive the car and go to school. Then, probably on Friday, I'm going to be driving, let's say, for 2 days. On Friday, I have a little house in the mountains, so I will go to the mountains. I have a large family. I have a wife. I have 2 kids. I have a dog. I have a mother-in-law. With that kind of priority, at least in my mind, right? I would tell people, say like, please bring this car over here. Someone is going to bring the car to IMD. The car is once again with insurance, so on and so forth. He's going to bring the car. He's going to take the car that I have and bring it somewhere else, so on and so forth, right? This would cost $3,100 per month. I can change the car once if I want. I can change the car 3 times a day if I want. As long as I book with 3 days in advance, 72 hours in advance, Porsche committed to actually bring the car, no questions asked. So this is the thing. Pricing. The pricing was about 25% more expensive than leasing one of these cars. But probably you're going to get a little bit more because you have the ability to drive all those cars and the flexibility that you want. You can be in the Porsche Passport for 1 day, for a month. You can be for as many months as you want. However, there is no pre-commitment. Generally speaking, when you enter into a leasing, let's say you book it and you're like committed for 3 years, 4 years, what is the length, the tenor of the thing? Here, you don't. It's month after month, you're going to be decided to be inside the Porsche Passport or outside the Porsche Passport program. Does it make any sense? So any questions so far? Good idea, bad idea? What do you think? Good idea? For whom? For whom? For whom? For customers, it is a good idea, guys. I can see myself as being part of something like this. Yes, absolutely. What about for the company? Say it again. It's a service, right? It's a service. It's a brand development. It's an expensive service, right? Because you have to have like a lot of inventory. I have to make sure that I have to do like all this logistics, which is going to be a nightmare. Porsche is not very much into the logistics part, right? Is into the manufacturing of the car. It was really a lot of new things happening in the company in terms of capabilities. It's something that you have to develop. And of course, if I pay $3,100 per month, I expect to get the car that I want. and I expect the car to be clean and everything to be like at Porsche level, right? It cannot be at Fiat level. Like if I put the thing, this is what needs to be done. So basically, this is what was going on. Why do you think that Porsche could come up with something like this? What is the ultimate objective? High middle income. Yeah, I
Middle
agree with
income
this.
come to, I say, the dream come true to
Finally, the
drive
dream come true.
any
Mhm.
Porsche, like you said. It's sunny day, I will have a cabriolet. If it is, I'm going to the mountain, I have a Cayenne. If you don't have your mother-in-law, you can have a Macan. So it doesn't matter. And also for who is very attached to status, you can go through your neighbor and show each a car different every day.
Very
So
much
there are
possible,
people
right?
that love that.
There are people, someone else, might love that. Not me, but someone else might love that. Absolutely, I agree, sir.
Financial
Sense.
sense for the company. Probably with some idea of the market. The CEO liked the idea, and the finance guy can have it. Or he's the sucker that
Very possible, actually. Very possible. So, anything else? I think you were commenting.
That's marketing.
That is
That's okay.
marketing,
That's
right? This is
marketing
marketing. Come from marketing.
because the depreciation,
There's some
the
depreciation
depreciation
over
is
there.
likely a
I would say that depends on the goal. Maybe what are gonna do with these vehicles after the sometime period? Maybe you have to break even. I don't know.
Those cars. All very good, I think, thoughts. The idea is a very simple idea. I think it's simpler than what we think. What do you think is the average age of a first-time Porsche buyer in the US? In the US, this started in the, oh, by the way, maybe I didn't mention, that started in the US, in Atlanta, and was limited only to 50 customers at the beginning. So at the beginning was like a really small pilot. The idea was like to scale it if it worked. Okay, if it worked, the idea was to scale it. I forgot, but it was done for 50 people. Sir.
2 years you buy a car
You buy a car
in
less
the
than 2 years.
US.
Now depends which car, yes, but I agree with you. Yeah. Yeah. So say it again. 52. 52 years old. The first time that would be nice. That would be nice. 52 years old. This is the average age of first time Porsche buyer in the US. What do you think? What is the first thing that pops to your? I'm listening. I'm listening. I'm here. I'm here and I'm listening. So that is the idea. The idea is like Porsche thought that it was a little bit, too advanced, but it's not. It's not. It's not. I'm not surprised. I'm not surprised what you think. Like you have to be a little bit advanced in your career in order to actually have like some sort of income. Probably, your kids are out. Schools are very expensive in the U.S. So it's not surprising that this is like another thing. But this is a little bit old, and they thought like, is there a way we can capture younger crowds? And all the story was created, everything was like digital, was created in order to get a little bit younger crowd. What is the average age of people actually entering in the Porsche Passport program? Around 37 years old. 37 years old is the average age, which is in line with what Rod was talking about over there. So that was the whole objective. That was the whole objective. The whole management team was kind of okay with that. The CFO was less, less happy, less smiling. But reality, well, 50 customers, not exactly 50 cars, right? This was a little bit of a multiple of that 50 cars, but basically this was about. Was this the right crowd? I thought that was the right crowd, because what happens is that because now we have these people, right? These 52 years old, I don't remember. Actually, I was not told how much money they made, but they suppose that this is 350,000 per year. Suppose these guys make 500,000 per year. So these guys were like younger, and they were like more, at least they have like more income of the 52 years old. So it was like the right crowd in some respect. What we know also is that these people would buy a Porsche car, every 8 years. So in this thing, if these guys behave like these guys, they're gonna be buying 2 cars more than their older thing. And that was very interesting, because this Porsche start thinking in a different way about customers. It's not about selling a car, but long-term value of a customer, because you are going to be entering in a situation, in a relation which is a little bit different. How long do these people actually stay in the Porsche Passport program? What do you think? Much less. It was about 5 months altogether. And what do they do at the end of these 5 months? 85% of them actually buy the car that they are driving. Okay, they actually buy the car that they're driving. So there was like a marketing way, or a sales, whatever, in order to actually get younger customers into this stuff. Successful, I don't know what is success in this case. What I know is that for the first, I think, 9 months, we had still 50 customers. That was really a small prototype, just to make sure to understand like everything was working. Then we live it up, and the highest amount of clients that we had in Atlanta was 360, with an average of about 280. So was it how to say, successful? I'm not sure what successful is. Was successful enough, so to speak, that we opened in Florida with 3 locations in Florida, and then in California with 9 locations only in Los Angeles, and then we're going to the lake area, and now this is available also in Europe. Okay, this is available also in Europe. They went from Porsche Passport, that was like one product, so to speak. Now all the mobility services of Porsche are under the spell, the umbrella of called Porsche Drive. So if you actually go online, you find Porsche Drive. Porsche Drive sometimes is in some locations, sometimes it's not, and there are different mobility services. One of this is this one, is the Porsche Passport program. So successful, but who knows? Start to some spec. Interesting. I thought that was interesting. Oh, also that I find it interesting. I always thought if I were part of the Porsche Passport program, I would really change 3 cars per day. One in the morning, one for lunch, and one to come back at night, right? You are paying for that, but apparently there must be also a little bit painful as well. Because what we found is that customers stay with the car for about the same car for 5 weeks. So there's not much, which is good for Porsche, right? Because you don't have all this headache of less cost and less headache, less possibility of actually making a mistake, right? So, but that was like 5 weeks with the same car, and on average, customers use 2.1 cars. So basically, when you enter in the Porsche Passport program, you kind of know what you want to do, right? It's not about trying the different cars. It's really entering in order probably to buy a car, or maybe to do something a little bit more long-term, right? If it's someone like me, I think given my demographics, blah, 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 I don't have a car, just for you to know. But if I had a car, probably I would have this Cayenne, right? Because of my lifestyle, the big family, so on and so forth. This is what I need. This is what I think I need in my mind, right? This need of this car, of this stuff. Most likely, I cannot swing it for 5 weeks with this car, right? I have to bring the kids to the jiu-jitsu one, to the swimming the other one, and then all this stuff. I don't think it's gonna work. Probably gonna be using this one. But it was very interesting. This is something that we really noticed. We learned throughout the thing. So this is basically something that I found interesting. Also, what I find interesting is why Porsche and not Maserati. Definitely not Ferrari, but even in Ferrari with the latest car that they came up with, I don't know if you've seen it. We were like a disaster in Italy, like, we can steal money, you can do whatever, but if a Ferrari looks like this, this is going to be talked by the government or something like that at that level. All right. Why Porsche and not Maserati? This is interesting. And actually, that was the initial discussion. The initial discussion was, how can we use our competitive advantage a little bit better? What is the competitive advantage? Is this lower depreciation of their assets. And you were talking about this, like, exactly as before. Lower depreciation of the assets. Why is this relevant? Why is this relevant? Because 5 months from now, you're going to be selling those cars, right? And that's the case. So the price was still there. Porsche could get rid of those assets at quite significant price, and life was a little bit better. This is 911, okay? Retail value with time, with respect. This is the average depreciation. I'm not saying that the price is going up. The price is going down, but it's going down to a rate which is lower than other stuff. This is what it says before. And anybody with a Mercedes here? Don't get upset, okay, for this thing. So just to make sure that you don't get upset, I put Fiat over here, or just to make sure, like, just to align our things. And I when I was in the US, Fiat in the US is fix it again tomorrow. So obviously this is not the kind of stuff that is still there for very, very long time, very, very long time. And so here we are, and so I started this project in 2019. I said before, I worked with Porsche maybe 2 or 3 years. 2025, I found this article on the Financial Times. Really, this is a couple of weeks ago, saying decrease in profits for Porsche 93%. Right, and that was like a little bit, at least for me, the end of a cycle of a company that was doing well and a company was making money. Now, I don't think it was because of the Porsche Passport program. I really mean it. I think it's like much more serious in terms of they made a little bit mistake with the electric vehicles. They had a little bit mistake with supply chain. They could not get some parts in time because of all this disruption that we have, the unfortunate disruption that we have in the eastern part of Europe. But this is basically in the moment in which really the company is not losing money, but almost losing money. It was the end of a period of that stuff. And it's something like, maybe nothing lasts forever, right? Nothing lasts forever. And so companies doing well, making profits, having like good growth, and then eventually this is not happening anymore. And then I asked myself, like, really, but does it? And this is what I did. What I did is basically I look at annual reports of 2025. I have a sample about 7,260 companies, so it's like an important sample. Each annual report is about 226 pages, so you understand, like, how much document we have to take care. AI definitely helped as a couple of really good research associates at EPFL, which is our in-house MIT in Lausanne. And we look at that. What are the 2 words in these annual reports that show up the most? Prices. What are the 2 words? Guys, I mean, this is the name of my class today. Profits and growth in revenue. So this is basically, I look at them and I find that growth and profits are mentioned 172,000 times on average in this annual report, and profits 168. Just to have an idea, like, how obsessed we are from these 2 things. And I'm sorry. Of course, sometimes may not be related, right? Absolutely, they're orthogonal sometimes, and this is exactly what this is about. I look at them, and so I choose those 2 words, this database, and I take my sample, and I divide the sample in companies with high growth and low growth, companies with profits and low profits, where growth and profits is parameterized by growth is top line growth year to year, 2019, 2018. and profits is return on invested capital, which is an asset-based measure of performance. Is operating profits over invested capital, so to speak, right? This is something, related to that. 7,260 companies, this 1,829, what does it mean? Out of those 7,260 companies, 1,829 are both high growth and high profits, okay? About 25% of them. The way in which I characterize this is a little bit, it's not more complex, but it's a little bit different. That is, I don't take all companies in the same sector. I calculate the average, and I calculate which one is higher, which one is smaller, in terms of taking care of differences in sectors. If you have like 20% of growth and you are in IT, maybe this is not that much because the average, let's say, growth is 23%, right? But if you are in cement and you do 7% of growth, given that the average cement is about 4%, you have a high growth company. So what we have over here is really a bunch of different names. It's not that I have all IT over here and all cement over here. They are going to be spread depending where they are with respect to growth and profits, and and they are going to be doing like this. This is what I do in 2000. Is it difficult to be here? High growth, high profits. Very difficult. How difficult? This is the percentage of the company. 25%. It's written over here. So is it difficult? Yes, it is, but not so difficult, right? For 1 out of 4, just by definition, right? It's going to be up there. Of course. So now let's make the movie, right? This is a picture. This is not a movie. Let's make the movie. And this is the movie that I do. That is, I calculate this 2019. Hopefully, I understand what you said, right? About the movie. And then I check what happens to these companies in 2025, right? I'm trying to understand not only how profitable you are, how good fit for growth you are, but what is the staying power? Maybe this is what you were referring before. And I calculate this. I have the same set of companies. Everything is the same. I can recalculate the same things in 2025. And this is what I find. I find, let's say that out of our 1,829 companies, 692 of them, they lost growth, they lost profits in this process, right? Going through COVID, so on and so forth. 163, they lost the profits. 663, they lost the growth. And only 312 are still high growth, high profits, right? And maybe this is what you were referring before. This is a little bit more like a movie, like trying to understand, and this is why I call it the transition matrix, how basically those companies move throughout the time, right? So what we learn over here is that only 312 companies were high growth, high profits. This is every year throughout all this period. I call this eventually the resilience, 312. These are 17% of 1,829, but they're about 4% of all the companies that I have in the database. So that basically means that only 4% of this company manage to keep up with the growth. Only 4% of the companies manage to keep up with the high level of profits. You don't seem to be very, very impressed by this slide. Yeah, I don't have very, very impressive place right now. Okay, I'll give it in color then. Let's see if you like it better. All right, do you like it better now? So, all right, so this is in color and it's fundamentally the same. Yes. Unsurprisingly, right? Because it has to be like going through every year. So eventually everything is going to be shrinking, right? It's a difficult world, huh? It's a very, very difficult world in which we are. And maybe we feel like this. But what is interesting, or at least what I thought is interesting, is that I call this the resilient, when resilience is ability to hold. Now, maybe you can say maybe 6 years is not long enough. And maybe you're right. Maybe I have to take 10 years or 15 years, but it's long enough. I think like at some level it is. With a pandemic in the middle, you have to be a little bit, anyway, so this is what we have and this is what we play. But this is nice for me because now I have 312 companies. It's not 1,819. This is a lot of companies. Now we have only 312. And basically what I do, I compare through AI, through the narrative, this is at least the objective. Try to understand what these guys do differently with respect to everybody else. So is there anything that I can get from the narrative of the data? And the data is annual report, analyst report, and everything which is published that we can manage to come up with a sort of statistical sense making, so to speak, of this stuff. This is what I do. 11 items come out of this research. Today, I would like to talk about one. I think it's more than enough at 7:30 at night. I think is more than enough for in terms of out of the 11. And what we find is 2 teams and 4 arenas. If there is something that we learn and we get out of this, is that these companies, they talk slightly different about the way, I call it where to play. Okay, where to play. They talk about different the way in which they manage the current assets, not current assets, the assets today in this moment, and where they play with respect to the new things that they want to start, new actions, new markets, new product. They speak about them in a different way, and also in terms of capabilities. They're very, very more adamant to make a difference between existing capabilities and new capabilities. And it's not that, once again, it comes out the structure, the narrative that they put in the annual report, and comes out through this factor analysis that actually put together a little bit of the statistical thing. Is that okay? So we have like typical, that really is a 2x2, which is something that we like to study in academia. The way in which I put this together, I put together like this. I put names in the stuff. Current, so if they talk about current market in which they play and existing capabilities, I call this sharpen. It's basically, this is what we do, and this is what we keep doing. We keep investing. We already have a product. We have something. We keep investing in that. We want to be a little bit sharper about what we do. This is really about continuous improvement, if you wish, trying to do things a little bit better or fundamentally better. This is the sharpen. On the other side, we have scout. Scout is basically entering new markets with new initiatives, with completely new capabilities. I call it scout because it's basically going for scouting new territories, scouting new things. And maybe some of you is maybe different. Maybe sometimes we call it perform and transform, but fundamentally it's the same story. If there is something which is a little bit different that I like to talk about, is performance and transform. That's really the two different polar opposites of this kind of balance, right? What we have over here is also this stretch. Okay, stretch basically meaning going to new market with new initiatives, using the same capabilities that we have, or gaining capabilities over here, but using in the same market, using the same initiative that we have. Does it make any sense? So this is the way in which I thought about this. It was very clear. It was very quick for the analysis to come up with this 2x2 matrix. The only real time that I took is actually to come up with 3 words that start with the same letter. So that was like the academic, coming up with this. That was the academic advantage and a contribution that I had. Everything else was very much happening with AI. And what we find is really this one pattern that came out also very, very clearly out of this data. And I have some names, and I'm going to be talking one of this. One of the names that I would like to talk today is Amazon, okay? Because basically, it shows this pattern, I think, very well, both traditionally and also a little bit more in the new days. Let me tell you what I'm trying to say over here. This is the history of market capitalization by Amazon. They went to the stock market in 1997. And by 2006, they were about $15 billion. I'm sure that sounds like a lot of money at the time. Today is like, it's a mall project by Amazon. Today, I mean, a couple of days ago, when I actually put this together, was about 2.6 trillion, right? So obviously many months and many have passed by that moment. And this is what I really would like to talk about. I would like to talk about AWS. You know what it is, right? So that doesn't need that much explanation. But I think what needs maybe a little bit explanation, at least for some of you, is how did that happen? How did that happen? And maybe And I really like this. So I'm going to be sharing, if it's okay with you, the slides with you, and maybe you can share with everybody. This is a really nice article that puts a little bit of things together. I also genuinely learn from some conversation that I had people at Amazon. But basically, this is a really nice article. If this is the only, how to say, the only source that you have, I would go and check in this article what is going on. And some of the things that the article would say is that AWS asset is so unlikely that it demands an explanation, right? You know, it was the way in which was born, the way in which developed, the way in which turned out to be was a little bit surprising, even for the people at Amazon. What is the whole story? The whole story is that at the beginning of 2000, 2002, 2003, which is about 6 years after Amazon was on the stock market, Jeff Bezos talks about that Amazon has about 70% of things that they were doing was like undifferentiated heavy lifting, fundamentally reinventing the wheel. Every time they had to put something on the web, 70% of the work is exactly the same. The problem was a problem for them, from Amazon, was a problem also for their customers, because they would do this work all over and over again every time they had to enter in a situation on Amazon. For Jeff Bezos, that was like definitely something that, of course, he didn't like. I'm sure that he was very adamant. At some point, the chief operating officer decided to address this. And what he says, the articles that it took 57 people, this 57, I don't know why it's really stuck to my mind. It took 57 people and start addressing this problem, all right? And it looks like these people actually that were part of this group were not very happy. It was not a very exciting, it was a very exciting initiative. They had to fix something that didn't work and to fix something that obviously was very complex and nobody liked it to do it. But anyway, they started doing it. They started doing it, and apparently in 2-3 years, they solved the problem. In order to solve the problem, of course, they did some acquisitions, they acquired some part of the capabilities that they didn't have. They increased the teams also from inside with new capabilities, and they made things happen, right? When everything was said and done, they were happy, the case is closed, they stop, they move on. The problem is customers who still have the same problem. And apparently one of the customers was a little bit more adamant than anybody else. It was DHL. Unsurprising, right? Because maybe I go to Amazon once, DHL will go and do deal with Amazon like hundreds of times per day. So they were very, very adamant. But they went to Amazon and say, the CFO, the chief operating officer, what is going on? How do you do this? And Amazon apparently was like so annoyed by this and say, okay, guys, if you want, this is the solution that we have. We have never tried with customers. If you want, you can try it. And legend says that when that happened, the people at DHL asked, how much money is going to be this? And the people at Amazon says, listen, it's going to be for free for the first 6 months. The only thing that you have to do is you cannot call us anymore. All right. If you have a problem, you fix it. We had enough. We don't want to hear from you. And says this DHL used the thing. 6 months later, they came back to Amazon and say, hey, we like this. We like this. And that was the first client from Amazon, right? That was the first client from Amazon. And then eventually Amazon sell to many more clients, and they're doing good today. Okay, so this is the customer problem, blah, blah, blah. Question for you guys, maybe I'll leave you a couple of moments. How would you map this AWS for Amazon? Say it again. New capabilities, new system, then a scout, right? A scout. So we all agree on that? When they started as what? Sorry? At the beginning, what they were trying to do? Solve a problem that they already had. Fundamentally, but once again, I don't know where I have no idea right now. But I think that they started over here. This is the problem that we have, and this is what we want to solve. How do you solve it? You recruit 57 people, 57 people, try to work on this, and eventually, right? And eventually, so this is what we find. First of all, it's like fixing the business. Fixing the business. This is about sharpen whatever we have. Then little by little, they both hired new capabilities, or maybe they went to small M&A in order to get those capabilities and get a little bit quicker, and actually went over here. This is what I call build the muscles. Build the muscles. So the first moment was like fixing, then you build the muscles. The second moment that you see over here is basically sell the muscles over here, right? And this is the moment in which they start, selling to first DHL and then increasing the amount of clients that they have. And then eventually, that was really an innovation that had exactly its general manager and all the stuff. And this is what we call Scout. So what I'm trying to tell you here is that, now, of course, I'm trying to make this a little bit simpler than what it is. I'm sure it was a little bit more confusing throughout time and so on, but was really starting here and going to this cycle over here. And once it's here, what is the last step that you have to do it? Because now you have a prototype, right? What is the next step? Then you have to scale. Then you have to scale. And this is the last step that you have to do, and make it core. If you cannot make it core, it's a nice to have, beautiful thing. It just wastes your time. Fundamentally. And this is the last thing that they have a painful situation for their operation first, right? And then eventually they try to solve it and actually try to enter into the stuff up here. Does it make any sense? Does it make any sense? Basically, this is what happens at Amazon. I think this last step is something that maybe we don't think too much. I think this is the most important. Being able to actually take whatever we have of this little project that we have out there and we make it core. Without this, there's not much cash flows that can be generated. There's a good effort, a lot of resources. So what? Okay. So this is something which I find very interesting. All right. It's okay, guys. So this is what we have. Of course. I still have a lot of sectors for that reason, because in order to classify you high growth is high growth in your sector, right? So if you have like a you still have, and so maybe methodological is a bit weird, but you understand what I'm trying to say. I don't want to have just technological companies. This is not what I think it's relevant, at least for this analysis. Sorry. Yes. Here you have. So what we find about this is that in 2025, what we find is these companies use these methodologies more than the other companies in order to run their business. So what I find is like one of the things about these 312 companies is that they go in this kind of flow. So they really talk about building capabilities first, okay? Building the muscle, then monetizing these muscles in order to start something new, and then they bring you to the core. So it's this is the thing. If this is some learning, this is the learning. This is how this 312 work in this flow. This is the way it works.
Right.
So this, to be honest, I'm not sure why that is the case. Okay, apparently it seems to be the method of choice, right? The method of choice. Why I'm a little bit agnostic on why they go in this direction. They go in this direction. And this is one very simple, I don't know if it's simple, but this is like one case. Another case that I like very much is Rolls-Royce. Rolls-Royce, not the car manufacturer, but the engine. The engine. When the new CEO entered in 2000, at the beginning of 2023, the company was about $10 billion or 10 million pounds, billion. I'm not sure about which currency in terms of market capitalization. Today, 120 billion. And it was very clear. If you actually go through what he did, and did a really nice interview, you should see it. I think I learned a lot myself with McKinsey, and how basically was, really going through these motions, and not with these terms, but fundamentally describing how the first thing that he thought about is like, how do we get the right to do what we want to do? I think he talks about, having the right. And it's basically about, how do it, and of course, it was like really horrible in terms of cutting people and cutting organization, but really sharpening the business. Then, buying capabilities through small acquisitions, bolt-on acquisitions, and through like, internal capability development, and then monetizing. And then having this smaller project that eventually became part of the core. Also, if you actually look at that story, it's very similar to this kind of flow that they had. So this is basically what is going on over here. What is the Porsche Passport program? What do you think? Here. Remember, what is the objective? What is the objective of the Porsche Passport program? New markets, right? So maybe around here, you would say same capabilities, new markets, but some other people would say, not really, this should be over here. The objective is like to sell more cars using new capabilities. It's like a sharpen with new capabilities, whatever that is somewhere around that stretch. And this is the history of Porsche kind of innovation, okay? They started with entry-level models. The smaller cars that are very much in line with what they were doing before. Then we have this SUV and crossover. That was a big step for Porsche. Okay, that was like, not many people actually liked these larger cars. I didn't know that. I learned through the research that they were done fundamentally for the Middle East market. They like to have drivers, and you cannot have a driver if you have like a small Porsche, so that you have a bigger Porsche, you can have a driver now. And then this was and is still very popular over there. Travel experience and track experience. I don't know if you know what it is. It's basically collecting a bunch of Porsche bros. They get together in the cars and they go to have an experience somewhere, like in the mountains. They drive, they're all happy, all right? And eventually the Porsche drive, as I told you before, right? What was the problem about this Porsche drive? It never became mainstream, right? Was not able to scale. So it was a nice to have, but not something that to say like, yes, now we got it. And of course, it was very difficult to scale because I think it's just a niche product. So they're trying to, scale a niche product. Guess what? It's not going to work. So this is not something which is. I'm sorry? It's not necessary. You can also bring your own if you want. So it's basically, you can rent through the Porsche Passport, your Porsche, or you can actually bring your own, right? And just drive with the other aficionados of the car, right? This is basically how it works. Not able to scale, that was the thing. And this is what I think we learned, this kind of stretch as a tool, right? And I think there was a lot of discussion, very much discussion between perform and transform. And I think if we believe what I said about this research, is a little bit more complex. It's about maybe getting some capabilities, monetizing the capabilities, re-getting more capabilities, monetizing the capabilities, eventually making whatever you have, making core and make it scale at that point. This is what this is about. Now, very possible, huh? 100%, yeah, 100%. So it's a little bit more complex, huh? A little bit richer than that, a little bit richer than that. So I would say it's a bit more complex than that. I'm trying to give it like a nice infinite sign. I think it's more complex than that. Sometimes companies go a couple of steps back and forth, right? And then, yeah, especially on that diagonal. And then they go to scouts. Now, I try to make it a little bit simpler, also for me, not for you necessarily. For me, like, yeah, just to make this work. And but I think it's more complex than that. Obviously, it's more complex than that. Sorry. Absolutely, right. But what is absolutely more risky. But I think if there's something that we learn over here is that this step to scout doesn't come in one step. It takes a little time and a little adjustment. So it's more like there is the last step, which is bigger than the normal step, but there's still a bunch of different steps, so to speak, rather than just one leap into the scout. And this is why it's all about stretch as a tool, right? As a tool to actually, really getting a little bit more ready for this big last effort that you make in that particular situation. Results. 2025, this is the second year in which Amazon publishes the results of its different things in different moments. The revenues of Amazon, this is US dollars billion. If you are confused, okay, this is serious money. This is serious money. $716 billion in terms of revenues. This is so big money that I have to have a reference. This is the reference. 2024, the revenues of Saudi Aramco. Saudi Aramco not only is the one sponsoring the World Cup, there's also something else that they do, which is selling oil for the kingdom of Saudi Arabia, 450 billion. So this is almost twice as much of the revenues that we have over there. This is serious money. Operating profits, 80 billion, about 11%. What is going on now? Now we have the results for AWS from 2024. That was basically published in a different way. These are the results. AWS actually makes 128 billion worth of sales that represent a little bit shy of 20% of the sales of their company, and make operating profits for 45 billion, which is 57% of all the money, at least in this year, which is done by Amazon, right? With a whopping 35% in terms of margin. So this is serious money. I'm sorry? I'll come back to this. I think this is a good point that you have, all right? And I was working in mergers and acquisitions at Morgan Stanley before that. So this is the kind of light discussion that I like to have. Amazon minus AWS does not exist, but I think this is like, whatever is left. Whatever is left is about a little shy of $600 billion worth of revenues, and with a profit margin of around 6%. So this is really the retail business, right? Very high asset turnover, very low margins. Is a margin which is very much respectable for a retail business, right? But you understand what is going on here in terms of differences, right? So the value of the company a couple of weeks ago was about 2.6 trillion with AWS. Then I did this very quick, and I'm sure you will jump at me on this, but there's really no reason to jump at me. I would jump on me myself, okay? So I was very quick, like, there's no reason to spend that much time. At these multiples for 2026, we are talking something between 1.4 and 1.8 trillion, all right? The valuation just of AWS. Now, once again, this is very quick, and that does not, but it's not difficult to believe, It's not difficult to believe that a company that makes 128 billion worth of sales, that bring home 45 billion, it's not difficult to believe that this is a valuation 1+. Yeah, 3/4 of Amazon, right? And of course, but once again, the retail business is not particularly rich, and it's not particularly growing also in that particular situation. This is something which is way more interesting, something which is way more active over here. I like to think about things this way. This is the average operating profit margin for my company, those 7,200 companies. This is the average asset turnover for those companies, and this is how they map, okay? This is Walmart, unsurprisingly, low profit margin, high asset turnover. They really use their assets in order to generate sales. They map around here. This is Hermes over here. Novo Nordisk, Nestle, of course, needs to be there. This is GM, not doing very well over here, right? This is really at the beginning of the asset. And Amazon is over here. We would put the Amazon retail business of Amazon over here, and the cloud business, which is a little bit closer to Hermes, is a little bit closer in terms of margin to Novo Nordisk. Just to tell you, like, what is the power. I call this the competitive map, right? Because that will tell us a little bit, how they stay in this. But look how powerful this business is. And believe me, that was like the worst, most boring business than anybody has ever thought about. Let's fix something that nobody can fix, right? Nobody was really happy to be part of that particular story. And here, this is where we are. Which is that if there is a little bit of a learning, is that sometimes we like to think that the best thing are obviously yet to come and must be like really far away from what we're doing now. We need new capabilities, new market, a lot of investment, blah, blah, blah. The story of Amazon tells us exactly the opposite. Huh? You fix what you have, and that's going to give you enough power to actually do something else. Now, they were a little bit lucky. I don't know, lucky is the right word. They were a little bit lucky, and they basically went in this direction over here. Is it all right? What else do we have? This is how we plug Amazon. The revenues over here. I plug this ABS over here, and voila, and Amazon. And this is why I think your point, I think, is very good. All right, would that make sense to divide these companies? You are part of the trifecta in you, right? I always talk that the trifecta is the board, CEO, and CFO, and that's him basically in one shot. What do you think? And I don't think anybody. No. What do you think? Does it make sense to break up this company? What is the business case for breaking up this company? Let me put it this way. That it makes sense, right? So you need investors that are willing to take one part of the bet, paying a little bit more because of that. We have what we call this conglomerate discount. It's not really a conglomerate, right? But obviously, what I always say is that about business like this, that the management team, if the company is run as one, needs to be a little bit schizophrenic, in the good way of saying, like, not in the there's no horrible sales. I mean, in the sense that when you talk about the retail business, you have to have a logic of continuous improvement, efficiency, being like really, really tough on these margins, really going for the kill. Okay. When you think about AVS, maybe you have to have a little bit different way of actually making investment decisions, like trying to risk a little bit more. Like there's a little more to be grabbed over there. And to have these two characteristics within the same person, the same management team, can be a little bit difficult in terms of the narrative that you want to have. You split them in two, maybe it's a little bit easier. Lately, I think it was like 12 of December 2024, someone, I think Elliot sent a letter to Honeywell. He's an active investor. They bought about $5 billion of Honeywell and basically suggested the company to split up Honeywell in two, exactly for this reason, right? There was like the aerospace that was going its own direction, and there was everything else. And actually, the company actually heard it, okay? And they heard it very well. The active investors want them to divide in two pieces. They heard it very well, and now they are dividing in three, just to make sure that that everybody is like with a different mentality. Fundamentally, for this to happen, is that the synergies must be very low, or lower than than the price increase. The two things can happen. So, and as long as there is a little bit of synergies, maybe it's better to keep these two businesses together. But I'm not really, I don't know about this. But these these are the things which are in line. What else do we have? Gen AI. And I like this very much because I call new tricks old playbook. If you actually look what the company is doing in Gen AI is fundamentally the same thing. First of all, really sharpen whatever they have. Internal coding, productivity, copilots, several tools, A+ ads. Rufus, do you remember Rufus? It basically was like when you enter in a page of Amazon, there's this little dog that helps you to do all the shopping that you want, which is basically powered by AI. Second thing they do, stretch their capabilities. What do? They bought some of this was actually bought. Anthropic, they made $8 billion in Anthropic. This new initiative, which is Amazon Nova, they bought it as well. And Tritanium is an AI chip helping in AI and reading a little bit better. Apparently, there's like 50% cost advantage with respect to of NVIDIA. This is what they say. I don't know if this is true, but this is how they market. After that, they build the capabilities. Now they sell the capabilities. And this is some of the initiatives that I have over there. And the Tranium and Inferentia done. And then the Scout Alexa Plus was not very, very successful in the first thing, and a lot of stuff with agentic AI, and trying to eventually put them back when they're going to be mature enough. So fundamentally, it's the same playbook. Fundamentally, the same playbook, new material, new stuff. Fundamentally, the same playbook. We first of all sharpen whatever we have. We stretch some of our capabilities. We try to monetize some of these capabilities. Maybe we go back and forth a couple of times in order to really get that muscle, and eventually we create something which is a bit new, and then we try to scale it back to the core. Conclusions. The 11 facts. Okay, I told you before that out of this research, I got 11 different things. This is one of them. And these resilient 312 companies are more likely to spend capabilities first, and then change market, stretching one dimension at a time, which is what I've been talking so far. And what happens at the end of this thing? Start here, stretch, scout, and then core. What happens next? You start all over. You start all over. I know that this is not the way in which you want to finish this thing, but this is exactly how this is going to be finishing. And this is very much in line. Once I was part of one executive meeting with Mr. Polman at Unilever, and there was this gentleman raised his hand, was part of the management team as well. It was a larger management team at Unilever, and sir, what will happen at the end of this transformation? And Mr. Polman, without thinking, said, well, we'll be ready for the next one, right? And it's exactly what is going on over here. All right, I think I told you that I would have been a little bit quicker, trying to apologize for my being late. If you have questions, I'll be happy to answer them, of course. Questions? Thank you so much for being here. Thank you so much for the organizers to having me to us the time. I will share with...
We will share it with everyone. Okay. I'm going to invite everyone now to step next door here, where we can continue a little bit the conversation. But since nobody asked any question, I'll address a question to you. In Brazil, we live an extraordinary high cost of capital situation. Interest rates here are absurdly high. Based on your studies, how does that impact the decisions and the conclusions if you're in a higher cost of capital environment?
Obviously, and I'm sure you know this better than me, becomes more difficult to the power of 2, the power of 3, right? And running the business becomes extremely expensive. In general, if you actually put a lot of high cost of capital and a lot of volatility, this is a little bit of the perfect storm for a little bit of a paralysis. So investment get like, postponed. I'm sorry. Yeah. This is investment get postponed and life is difficult. And that is the moment in which you really have to deliberate. You really truly have to be deliberate to actually do things in a different way, because otherwise it's going to be very, very difficult. I know I'm not telling you anything new, but I know that you know that. But this is exactly what happens in a situation like this. So the only kind of way out is being very, very deliberate about. I'm sorry. Or be a bank. But let me tell you, that also banks are not very happy about what is going on. Huh? Yeah, they are. They get a lot of money, but I'm sure also I'm sure that the risk officers are scratching their heads and doing a little bit of calculations themselves. Huh? I think new markets can be sometimes more capital expensive. Huh? Capability is a bit riskier, because sometimes you have to buy companies, and then sometimes you need capital, but also the ability to integrate becomes really a little bit of a headache. I like small acquisitions. I like, very bolt-on acquisition. Don't do something completely crazy. Just trying to be as focused as you can. That might demand a little capital, but otherwise, new markets, that would be better. That would be better, right? Something which you have a little bit and skin in the game on both sides. Skin on the game on both sides.
One more question. And this is not specifically for Brazil with higher cost of capital, but it's a global question. With artificial intelligence and all the new challenges coming ahead, corporations, they have to be much more cautious than startups. They have to take measures to avoid going wrong with artificial intelligence and not doing stupid and dangerous things, where startups can risk a lot more. And eventually, startups, most are going to fail, but taking much more risks. A few are going to survive and disrupt the business of the corporations. So with artificial intelligence and with so much innovation going on in the world, most corporations will be in a matter of time in serious troubles due to disruptions which will emerge through startups. I guess you kind of answered already. One thing that companies should then do is acquisitions by smaller startups because they can't develop that themselves and run the risks that the startups can run. Could you elaborate a little on that?
I completely agree. So I'm not sure if I 100% buy that corporations had to be more careful. I think there are moments, like, the starting moment, the idea needs to be incubated in something which is small, and then I agree with this, under control. But eventually, I want bigger corporations to be deliberate and buy out some of the capabilities of this company. So I think this is what we're seeing already. Yeah? This is exactly what we're saying. If you actually look at most of the, the most important companies are already buying here and buying there. There was this company, I can't remember the name, was basically bought by Google. So there was an engineer at Google that was working within Google. Then he left Google because he had an idea, and Google didn't want to work on this idea. So the guy left. The guy left, started his own company. After 3 years, guess what happened? Google bought it back, 2.7 billion. All right. So the guy is very happy. He has exactly the same title that he had before, but a larger bank account. And I think maybe this is the way in which it's going to be happening. But you cannot not be deliberate enough, once again, in making those bets. Right? There are these kind of things in which you cannot you cannot not make it. Let me give you an example that I did on my life. Maybe 10, 12 years ago, there was blockchain. Remember? And it was like this big, big thing. Maybe because I didn't fundamentally understood what it was. Maybe there also might be this reason. But I thought like this is not something interesting to me. So I studied. I have a deck about 300 slides. And after the end of the deck, I was like, you know what? I don't care about this. I don't care. I don't think there's going to be a big life. I don't think it's going to be as transformative as we think. And really, never taught a class. And I was completely out of the discussion. And it was so silly of me, right? Because for 12 years, it was a discussion. Maybe sometimes it's still a discussion. And still, I'm not part of the discussion. And I told myself, this is not going to be happening again, right? This is not going to be happening again. There is something important. And I decide out of my, this intellectual phenomenon that I have that this is not interesting, right? So in that respect, I think like I'm going to be studying. And if I were companies, I would invest in that, even if it would be maybe more logical to wait a little bit before investing. I don't know if I'm clear on that. We cannot let this pass. We just cannot let. It's going to be done. I'm not sure. Most likely it's going to be something that really is going to be revolutionizing the way we work. Some of the low-hanging fruits have already been taken. The very transformational stuff, we have no idea of what is going on. I've worked with this asset manager it's a large asset manager in the Netherlands. They have about 500 billions under management. So it's very serious, okay? And let's say if they have an investment process, which is what they do, right? They have investment. So they have an investment process. This is their competitive advantage, right? Suppose that is 11 steps, so to speak. They say, how can we improve step 3? How can we improve step 7, right? And of course, they work on this, and they did a lot of step forward on that. But this is not what they want to do. They want to do is like, how do you reinvent completely, remap completely what is the investment process? This is something that they're going to be working in the next 3 years, in the next 5 years. But this is, you cannot not do that. So this is, and as a CFO, I think this is the kind of tension that you have to mediate, right? So it's going to be interesting. Arthur.
So first, thank you to be here and congratulations for presentation. Amazing paper. My question is, in your framework, your first step, it's try to build some capability. Okay. Did you see some pattern between those companies, in between develop inside of the company and accelerate programs or something like this, or do some M&A or corporate venture? To have some patterns or difference between industry or something like some thoughts?
So this is a very good point, Arthur. To be honest, I'm not sure. So I know because this is what comes out, that is this capabilities is a mix between developing internal capabilities and buying capabilities. That we know. If there's a difference between sectors, I'm not sure about that. I'm sure it's somewhere in the data, but I didn't have enough time to actually look at this. And that could be interesting, though. Huh? That would be an interesting question that maybe I should ask myself. Absolutely.
Yeah, I'm seeing some kind of challenge in the market today between those decisions. What should you do? Buy new capabilities or accelerated by some M&A or develop inside of the company? Because sometimes with a strong governance, as you say, startup can be more take more efficient, more efficient.
Absolutely.
Yeah. And so sometimes they prefer to keep those experimentation discovery path side of the company, and I'm just curious about that.
So I don't have an answer. Maybe you do. Oh no, I thought that yeah.
Sorry.
But I think Arthur, I think this is an interesting question. Which capabilities we buy and which capabilities we develop internally, and if there's a logic on that. That would be something good to know, and I don't know, but this is something that I'll take note of this.
Hey, thank you for your lecture too.
I thought that the questions were over. I thought it was the time for drinks.
We just needed a kick.
Tell me.
Actually, I'm going to change a little bit, like the main point that we're discussing, because I understood that we ended up discussing how to achieve both growth and profitability at the same time. So how the modus operandi for that. But I'd like to understand if there's on your research or on your analysis, there's a path between that you move between, like before you're gonna have growth and then you're gonna have profitability. When does this both financial returns, financial ratios actually take place during the operational process for you to achieve that?
So that is not in my paper, but just because I think I didn't think of that. But in general, what we know is probably growth comes first. Generally speaking, right? Generally speaking, trying to acquire growth before reestablishing profitability, right? Especially because even sometimes that growth would cost you.
Yeah.
Some stuff it's not you're gonna get the results right away.
So it's like when we saw like the percentage of the companies that were in that 4 steps on the 2025 annual reports, we had like a concentration in both low growth, low profits, and high growth, low profits. So of course we had like the moment of the market after COVID and high interest and etc. But one could like expect that some of the companies that are on the high growth and low profitability at some point they're gonna go to
Absolutely.
high.
Absolutely.
Cool.
Yes.
Okay.
Yes.
Okay, so once more, I would like, in the name of IBEF São Paulo, and I am the alumni club from Brazil, thank Professor Salvatore. Thank him with a hand of applause. And invite everyone next door. Please, everyone, por favor, todos, se puderem responder a pesquisa de avaliação do evento, copiando esse QR Code e respondendo. If you can please copy this QR code and answer about today's event. Thank you.